information champion because as it stands right now, I have not yet been proven incorrect. And I stand by that. But it's always good to fact check your information. And if you guys benefit from some of the trading information that I give you that helps you guys be able to take common knowledge and turn it into actionable capital, you can always show some support to the channel. Uh, what is it? Likes and special emojis and special comments, or just specifically a donation of any amount to say I appreciate what you've done. Just remember, YouTube's going to take half of it because YouTube is a business. Now, I want you guys to understand it really does help the channel and make sure that I want to make sure that you guys do not miss out on future breakdowns that we're going to have. Also, throughout tonight's show, I want you guys to take the time as you're enjoying the show to utilize those reaction buttons that's on either side of the screen. I'm not sure which side it's supposed to be because I'm thinking it's over here, but I think that it's over here. So because it's a flipped inverted scenario. But yeah, it's over here. Yeah, it's just like I thought. It's over here. I just seen the catch up, the lag. So utilize those reaction buttons and try to make sure that you show some support because that helps more people get a chance to see us. While I got you, because we're about to dive into this. YouTube has this restricted mode thing going on, and my platform, a lot like a lot of other platforms to talk about things that are political, ends up in that restricted mode. So if you're seeing us today by accident or on purpose, make sure that you guys take the time to go into your settings on your iPhone or Android and go down to restricted mode, turn that off, and you will be able to see my platform and plenty of other content that YouTube has to offer that has been limited to 18 and over group. So that helps you eyes out with being able to find me in the future because as long as you have restricted mode on, even if you knew what platform you're looking for, if you didn't accidentally stumble across us on the For You page, you might not be able to see us if you don't have us subscribed and you're not looking for us directly. So just want to make sure that you guys pay attention to that. Now, let's get into the first and maybe the most explosive stock on the list. Kicking things off is the company that's become the face of artificial intelligence revolution, Nvidia. Now, we're going to be talking about Nvidia, and I believe Nvidia is like NVD. And I should have got you the ticker for that one. But Nvidia hasn't been just a stock, it's been a force of nature. Its GPUs have become the essential tools for the biggest tech gold rush of our current generation. So when you hear about companies building massive AI models or powering next gen data centers, they are almost always using NVIDIA's hardware. This total dominance has led to financial results that are almost hard to believe. So the company has been reporting mind-blowing revenue growth with its data center division recently soaring 154% in a single quarter. Analysts are projecting that full year revenue could hit around $115 billion for the fiscal year of 2025, with even more growth expected after that. This isn't just growth, it's hyper growth. And it's all fueled by a world that has a bottomless appetite for computing power. The main thing pushing Nvidia higher in 2025 is still its absolute leadership in the AI chip market. So think of it as this: AI models are like engines, and data is the fuel, but Nvidia builds the actual engine. The hyperchip that they have, like the H100, became the industry standard, but the upcoming Blackwell platform is expected to be another huge leap forward. set to revolutionize AI performance all over again. So these aren't just small upgrades, they're generational shifts that allow for bigger, smarter AI, which is one of the reasons why you're starting to see a lot more of the robots going around. And you're looking at a lot more AI content being created on YouTube. Every major cloud company, Amazon's AWS, Microsoft's Azure, and Google Cloud, and thousands of other businesses are in mad dash to build out their AI infrastructure. And Nvidia is their main supplier. So the demand isn't just from US tech giants, it's a global race with the AI projected to grow at a compounded annual rate of 37% through 2030. Nvidia is standing right in the middle of a wave spending tidal wave to provide you with growth over growth over growth, almost like the tsunami that just happened a couple weeks ago. Wave after wave after wave. While data setters get all the attention, Nvidia isn't a one trick pony. Its second major growth driver is the move into other valuable areas, the gaming division, which was Nvidia's original business. They're still solid performers with its popular RTX technology helping to boost sales. But what's really exciting is the automotive segment. Nvidia is partnering with major car makers to power their next generation autonomous driving systems in their tech cars. So this is massive long-term plays. So on top of that is in the works edge computing and creating digital twins, virtual models of real world systems, which is opening up brand new markets in manufacturing, robotics, and healthcare. This diversification is crucial because it creates more ways for the company to grow and reduces its reliance on data centers spending alone. Now, for the risk, and the first one is impossible to miss. Nvidia's valuation is priced for absolute performance. As of mid 2025, the stock trades at a premium valuation. When a stock is priced this high, there is no room for error. Any hit of slowing demand, a slight miss on quarterly earnings, or guidance that's just good instead of incredible can cause a brutal stock correction. We saw a preview of this in early 2025 when the stock pulled back significantly on market concerns. Investors are betting on flawless performance for years to come. The problem is the world is rarely flawless. So this high valuation means that even if Nvidia, the company, continues to do great, Nvidia, the stock, could still go nowhere if it doesn't smash the market's sky high expectations. The second hidden risk is the triple threat, the historic boom and bust nature of the chip company, growing competition, and geopolitical stress, as we just finished talking about yesterday. The semiconductor industry has always been uh, cynical, where in a massive boom right now, we would experience capex fatigue, which is a very real worry. Nvidia's biggest customers, like Microsoft and Meta, are spending tens of billions on chips, but they're still waiting to see a clear return on that AI investment. Any pullback in their spending would hit Nvidia hard. At the same time, the competition is working up while Nvidia has had a huge lead. Unfortunately, companies like AMD and Intel are pushing hard to develop their own AI chips, closing the gap with Nvidia. So, even more importantly to recognize, since Nvidia's biggest customers are also its biggest potential rivals, Google has its TPUs, Amazon has its Triton chips, and Microsoft is developing its own custom silicon. And let's not forget Snapdragon, which is software on a chip. Their goal is to rely less on Nvidia over the long run. Finally, there's China US exports controls that have already cost Nvidia billions in potential sales, and any more restrictions could disrupt its supply chain and its revenue. For Nvidia, the story for 2025 is a bet on continued absolute dominance. The upside is huge if they keep delivering, but investors need to know they're paying a premium for that potential, and the road ahead has plenty of risks that could change that story fast. For individuals that are aiming for lower risk and continuous gain, we're going to be covering others in different shows as to what you guys could grab that would be less volatile than the Magnificent Seven, but you can grab the Magnificent Seven as a starting point. You can also grab Netflix. You can also grab the TKO, all growth stocks. Well, TKO is a dividend stock, but they don't pay that much in dividend. Now, next up is the quickest giant that has roared back to the center of innovation, which is Microsoft. And I should have grabbed you guys the tickers for these. And I thought I grabbed the tickers for these, but I created this last week and I didn't double check. But if you type Microsoft in to any of your trading platforms, any of your fintech, Microsoft or Nvidia, it'll give you Microsoft or Nvidia and it'll give you the ticker for it. So you know that you're in the right spot. Now, Microsoft for years was seen as dependable and almost boring software company. But under CEO Satya Nadella, it has become a powerhouse in cloud computing and more recently AI. So after trailing the S&P 500 in 2024, Microsoft has come out swinging in 2025 with the stock up significantly. The engine behind this is clear. Microsoft is arguably in the best position to actually make money from the AI revolution at a massive scale. So they're just building the tech and they're weaving it into the software that the entire world uses for business and every day operations. Microsoft's main growth engine is its cloud platform, Azure, as I mentioned earlier, and it's been the strong number two behind Amazon's AWS for years. But AI has put its growth into overdrive. In its recent fiscal fourth quarter, Azure revenue grew by an incredible 39%, smashing analyst expectations. Again, telling the company uh, that AI services were a huge part of that growth. What Microsoft did so brilliant was partner with Open AI by getting exclusive access to their best AI models. Microsoft made Azure the top destination for companies wanting to build their own AI apps. But the real genius is the integration. They aren't just selling computing power, they're selling a complete AI platform. The strategy is working so well that the company has said demand is so high, it will be capacity constrained for a while, which is a great problem to have for them, meaning that their growth is limited to their ability to produce. Special shout out to Michael. He said $529 a share, 1.4 up, 1.4% up. And you guys got to understand, these Magnificent Seven, these stocks are pretty expensive. I can find you guys for upcoming shows some growth stocks that are cheaper, like BBAI, that's less than $10 a share, that is likely to grow significantly over time. But if you buy these in the form of ETFs, where you put up a percentage of the value of the stock. You can continue to add money to those stocks when you're trading through ETFs until you reach that $529. So if you don't have $500 to put down on one share of one of these stocks, you could put down $50 in each one of them through ETF trades and be able to own the value of that stock and still experience the growth related to that utilizing fintech software. Still, you're able to build your platform and you're able to build your growth. It's just something that you have to manage and plan in order for you to be able to really expand your diversification. Now, one of the things I want you guys to remember, because we do have the dividend rotation strategy working right now, ABR has been exploding this month. So getting into ABR before Friday, because the 15th in 3 days, which is Friday, is the ex dividend date, and you have to buy it by Thursday, which is 2 days from now. Well, right now it's midnight. Uh, so today's Wednesday, Eastern Standard Time. So today or tomorrow, you have to buy your ABR stock, and then we're going to sell it on Friday so that we can utilize that stock difference where it has gained, depending on your investment levels, a few $100s in growth, which means that when we sell it, we're not only going to get the ex dividend, we're also going to get a few $100s off of the growth. Then we're going to take the values and we're going to throw it into RM for Monday so that we can sell RM come the 20th, where we're going to get the ex dividend from RM, and then we're going to relocate the remainder to our Orchid Island stock because it's the lowest stock between Orchid Island and AGNC that has an ex dividend date on the same day, and we'll be able to pull off a massive ex dividend off of Orchid Island as well. And then we're going to start migrating into. I'll have to cover a show 2 weeks from now as to which stocks we're going to be getting into for September for our dividend rotation strategy. So every month I give you guys a heads up, and every month I let you guys know which ones are making bank, so that if you're going to follow us with the dividend rotation strategy, you can increase your wealth as well. We've been keeping track of our. We've been able to cover thousands of dollars a month in comparison to what you get from um, trade, not trades, but high interest savings accounts, high interest money market accounts, CDs, uh, treasury bonds, stuff to that effect. We've been getting way more than what you would get off of some of the stuff like that. Even doing a buy and hold with a really good stock portfolio, the growth is averaging 8 to 15%. And we found some that we've been using that's between 15 and 27%. And even at 15 and 27%, because we're doing a dividend rotation strategy in a growth market right now, we are experiencing more than 75% uh, return annually, where we're receiving 3 times as much return monthly off of every stock, because each one of the quarterly stocks we hit is a once every 3 months payment that we're getting every month from different stocks, because we rotate out whichever quarter we're in. And that allows us to make 3 times more than what we would have made had we did a buy and hold. So you got to follow us and see what we got going on, because We're coming out of the woodwork with all kinds of different things. And I'm going to be real with you. That one day I'm going to have to really set up a full list of all of the stocks that we've covered throughout the year as that and try to see if we can make a really large balanced portfolio. But I have on average given you between 7 and 15 stocks that you can utilize in any one type of portfolio. But if you want to be the most diverse, you could try to put them all together and see what happens. Like Ash Ketchum, you could catch them all. You could put them all together and see what happens. Instead of having different platforms, you can. But it's harder to monitor 75 stocks without extra fintech operations. It's harder to monitor 75 stocks. But again, if you're doing buy and holds where you're not getting rid of any of your stocks, you're going to buy those stocks, you're going to hold on to them, you're going to take the dividends, you're going to live off of the dividends, and then you're going to just reinvest your the difference that you don't need back into your portfolio. Then it doesn't really matter what's happening to the stocks as long as whatever you need is covered. So there's that. Back to it though, if Azure is the engine, Copilot is the transmission. Copilot is putting that AI power into the hands of every user for the vehicles. This is Microsoft's second and maybe most powerful growth driver. Copilot is a brand for its AI assistants, and it's being built into every single Microsoft product. So you're going to see it in Windows, Office 365, Teams, and its coding platform, GitHub. This is a brilliant business strategy. Microsoft isn't asking its hundreds of millions of users to try a new product. It's just upgrading the tools they already live in every day. So they are turning AI into a subscription, which means everybody's going to be paying for it. GitHub Copilot, for example, has already attached over 20 million total users. This creates a very sticky, high margin, reoccurring revenue streams that nearly impossible for others to copy because they don't own the underlying software ecosystem. It's a huge competitive advantage that's only getting bigger. With great power comes great scrutiny. And this is Microsoft's biggest hidden risk. So the company is once again in the crosshairs of regulators around the world. And look, we had that flash again in both the US and Europe. So antitrust investigations are picking up steam. Regulators are looking at whether Microsoft is unfairly bundling its Teams app with Office to get an edge over competitors like Slack. And they're also digging into the structure of its cloud business and even its close partnership with OpenAI, seeing if it's an anti competitive deal. The same way Google got sued for monopolizing the market because Google is the primary search engine as a default for every device, which pushes out other search engines. Like if you notice, everybody knows about the Google search engine because it is the first one that pops up on your cell phone, on your laptop, on every device that you have, your tablet, whether you have a PC or a MacBook. It with MacBook you have Safari, but you don't feel comfortable about not backing up Google Chrome. But with um Androids or Windows, it is either Microsoft Edge and Google Chrome. Google's everywhere, and they got with the monopoly. Michael said bought one touring bike with padders, caged pedals, 18 speed high end saddle for $20. sold yesterday for $179. $9.19. Well, he's out there buying estate sales, y'all. So he goes places, looks at nifty things, picks them up on the low, and then he goes out there. And because they're in really good condition when he grabs them, he goes and reassesses the price and goes out there and goes and does it. Yeah, Google's been a monopoly, and because Google has been a monopoly, um, Google has been sued for that. And I don't know if they even really changed their practices much because I have noticed that almost like a virus that Yahoo search engine is starting to force its way in. Duck is so starting to force its way in. Bing is starting to force its way in. And I literally have to do malware blockage to stop those pop-ups from forcing those in here. Oh, you're checking the time to see if it's to see if it's going to flicker off on us. I think I resolved the issue because it was supposed to be related to the VPN, and I typically operate on the VPN. The VPN is functioning now. I had to reboot the VPN. Uh, I actually had to uninstall the VPN completely and then reinstall the VPN and do a repair kit on the VPN in order to get the VPN to work again. Because I kept getting this notification that there was a glitch in the VPN, and the notice came from the VPN, and I didn't pay attention to it for a while, and then I started looking, and I'm like, let me go ahead and see if I can, because that's like the only thing that I put on this computer that didn't come with this computer that I have not taken off of the computer to eliminate everything else. Yeah. Now, these investigations move slowly. So the ones that they're having against Microsoft move slowly, but they are a major long-term threat, the same way it was with Google, because it negatively impacted Google stock when it happens. A negative ruling could lead to a huge fine or multiple fines, or even worse, force Microsoft to change its business practices, potentially breaking up the very product bundles that makes its ecosystem so powerful. So Microsoft's second risk is a mix of execution and competition. While the company's AI vision is brilliant, making it happen is incredibly expensive and complex. Microsoft is spending tens of billions on capital expenditures, mostly for NVIDIA's GPUs to power its AI services. And that puts pressure on its profit margins. Meanwhile, the AI war is far from over. While Microsoft got a head start with its open AI partnership, the competition is fierce. Google's Gemini models are incredibly powerful and are being built into its own massive ecosystem of search, workspace, and cloud. Amazon is also pouring money into AI for its AWS platform, and the AI landscape is changing so fast that a lead today doesn't guarantee to lead tomorrow. So the moment Microsoft stumbles, its competitors will be ready to pounce. So for Microsoft in 2025, the investment chase is a bet on brilliant integration and monetization. They have the distribution, the business relationship, and the AI vision. If they can navigate the regulatory minefield and hold off fierce competition, the growth ahead could be massive. Now, our third stock is another giant at a crosshair. It's going to be Alphabet, the partner company of Google, or the parent company of Google. I want you guys to understand that. So, Alphabet owns Google. For 2 decades, Google has a virtual monopoly in search, as we just finished talking about, turning it into one of the most profitable businesses ever. That money funded everything from YouTube to its self driven cars project called Waymo. But for the first time, the king's throne looks a bit shaky. The rise of generative AI is the biggest threat to Google's core business since it was founded. But despite this threat, Alphabet is far from beaten because the company is using its own deep AI research, its massive amount of data, and its incredible engine talent to fight back. So the market might be under underestimating its ability to not only defend its territory, but also find new ways to grow. So, recent financial results have been strong, with Google's cloud in particular showing an impressive acceleration, growing 32% to 13.6 billion in a recent quarter. This suggests Alphabet is successfully becoming a more diversified AI company. Michael says, any companies that are building cloud servers, solid profits for years and years to come. We talked about that yesterday because anybody who buys an Oracle, when Oracle buys TikTok, TikTok is going to explode and Oracle will explode too. It is what it is. If you get a little bit of each one of these stocks over time, and then you put a lot of you like it's one of the things that I told you guys I think last week or the week before. If you're doing this like ETF style, micro investments, marginal shares, and you put a little bit of money on each one of these stocks that you need, and then you might do like 85% onto that highly volatile Orchid Island stock that's throwing out a large quantity of dividends for a small quantity of investment. And then you take that dividend and then you rebalance the platform by adding those monthly profits onto other uh, growth stock, other cash stocks, and then take those cash stocks and rebalance your growth stocks. If you take your highest paying cash stocks and put it on your less high cash stocks and continue to do that until you get to your lowest paying cash stock, all of your cash stocks will increase in value. Then you can take the next time around because this is going to be like a monthly turnabout. You take your uh, uh, cash stock and buy into a growth stock while the growth stock is down, and you alternate. Every month, you take a chunk of change from all of your cash stocks and you either buy into an increased cash stock or buy into a downed growth stock. And that will allow you to increase your portfolio to a magnitude where you will have the ability to leverage your platform to go and make changes. Because as I told you before, if you're if you leverage your portfolio, they're typically going to give you about 70% of the value of your portfolio. So if you're over 100 grand on a portfolio and you leverage that for 70 grand, you don't need 70 grand. But if you did, you'd be able to utilize the 70 grand for whatever it is that you want and then make the payments off of your portfolio. So what if your 70 grand that you leverage was going to pay for your standard of living for the next several years and then the platform pays on the loan for the next several years? Now you're not even being taxed on any of the profits you're making off of the platform because of the loan. And that gives you the ability to live a good life tax free and still be able to increase your platform. And none of that's all about using the money in the platform in the stock portfolio to run your life, which has absolutely nothing to do with the money you're making off of your day-to-day job. Now Marcus said, did you know that Uber is the biggest car company in America but owns no cars? I actually did not acknowledge Uber as a car company. I acknowledged Uber as a rideshare transportation app, which subcontracts the requirement to transport people to the individual car owners. Um, but I did it would be a cab service with no cabs. But I didn't think that it was a car company. But that's a good way to observe it though. Anybody who is using Uber on a regular basis, buy you some Uber stock, get you some Lyft stock, because as the cost of cars go up and more people don't have one, and those people who don't want to drink and drive and they want to go out and party and have a good time on the cab, and those people who don't want to pay to park their car at the airport, who would prefer to get dropped off at the airport by an Uber or Lyft. Ubers are cheaper than taxis, so invest in Uber and Lyft because that is a growing market. Wolf is a private security company that modeled the Uber rideshare thing, and they provide armored drivers that will take you where you got to go and cover you with live fire if necessary. So that's also good. So if you can afford to upgrade to Uber's luxury edition, you can afford to get Wolf's uh, armed guard situation. But I mean, not very many of us really need somebody to protect us with firearms. We've got our own. You just carry in your Uber. Alphabet's main growth drivers is its ability to successfully weave its own advanced AI, Gemini, into its core products. So this isn't just about playing defense, it's about evolving. Google is responding to the threat of AI chatbots by reinventing its own search engine. So new features using Gemini model to give direct conversational answers to questions, which completely change the search experience. You guys, if you have not noticed recently in Google, there is a deep dive AI mode where you have in your search bar you have like images, shopping, blah 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 to the right. You have your all, and then you have your AI deep search on the left. And if you go into the AI deep search, it literally does a full on deep search that's supposed to give you something similar to or more in depth of the original search that you get on the Google search page. So the key here is that Google has a massive advantage: data and distribution. It still owns the vast majority of the search market and has a direct line to billions of users through Android and Chrome. So the company is betting it can create a better and more seamless AI experience than a standalone chatbot. Plus, Gemini is being built into the entire Google ecosystem, from helping you write emails in Google to organizing data in Sheets. This deep integration could be a powerful way to keep users engaged and find new ways to make money. Now, the deep search option that they've had on Google was offset because when they started talking about Gemini on the Galaxy S24 and S25 Ultras, they were talking about a level of Gemini that had a subscription. I don't know what they did with that subscription, but if you wanted the in depth engine, you had to pay for it. Those individuals start regulating that search. Ultimately, you're going to end up renting the internet. You're going to end up, in order to get all the best features on the internet, you're going to end up having to rent the internet. And it is what it is. That's going to be one of those things. But by doing so, these platforms that are integrating all the tools that you want to use into the average product, you're not going to have a choice but to pay for the product or deal with a shit ton of ads to offset. Beyond the search, Alphabet has two other huge growth engines. The first is YouTube, which is what we're using right now. It's still the undisputed global king of online videos, and it's still growing. The rise of YouTube Shorts has successfully fought off the threat from TikTok, not to mention the ban kind of helped that out, keeping users on the platform. Ad revenue is strong, even though up and coming content creators struggle to get to that sustainability of 1 million subscribers, or that's at least 500,000 subscriber sustainability, where they're capable of generating um, moderate standard of living revenue. The startups, anybody under 100,000 are struggling to get to 100,000. And once you cross over 100,000, it's kind of easier to get to that second 100,000, that second million. But getting there is what's the case. Now, ad revenue is strong, but Alphabet is also finding new ways to make money through YouTube Premium and YouTube TV subscriptions. The second engine is Google Cloud. So for a long time, it was a distant third in the cloud wars, but it's now a major player and a key driver of profits. So its revenue growth has picked up, and more importantly, its profit margins are getting much healthier, recently hitting nearly 21%. Google is using its expertise in data and AI to win over large corporate customers. As more companies look to use AI, many are turning to Google Cloud for its powerful tools. So, this diversification is critical as it makes Alphabet less dependent on ad revenue. Michael says, scary with all these cameras looking at us daily instead of looking for aliens. You know, all the aliens got to get a passport before they come, because if they don't, they're going to get deported. So if they come down and they flying saucer and they don't show their real ID, they're going to get it. um, but again, you got to think about this. Don't nobody really care what's happening in space. They in Asia, their country is watching their civilians so much they have little to no crime rate. America is replicating that and utilizing CCTV cameras to watch their civilians so much that they should know where you're at when they want to come get you. You just have to not be doing stuff that would give them a reason to come get you, because there's not very many ways to hide. You would have to genuinely purchase a massive acreage of property and deliberately set up equipment that would black out radio signals, and you would have a dead zone in your area where nothing works, which means you wouldn't be able to podcast from there. You wouldn't be able to take phone calls, text messages, or emails from there, but you would be safe from the watching eyes of the Uncle Sam. You would have to drive you a car that was made in the 80s so that it would not have all that tracking software in there. You would have to really be old school, because that's the only way that you would be off the market. Then you would still have to buy extra equipment to cover your license plate, where they would not be able to take photos of your license plate when you did go into town. But once you went into town, they knew who you were and they knew which direction you went when you were last seen on camera. So it's not like they can't find you. They're going to be looking in the geographical area of where you were last seen, canvass that particular space, and then pray that they encroach on your property correctly. But it is pretty disturbing to know that because everybody clicked approve on all of the apps that they have on their phone, most of the apps on their phone gives the app permission to turn on their mic and their camera without their knowledge or consent, because they've already given consent, which means that it doesn't take much for the usage of your camera and your microphone to be accessed by a third party that hacked into that system, which means that any one of hundreds of apps on your phone that has permission to access your camera and your microphone could be listening in to our conversation right now. And rightfully, it actually does. Because anytime we talk about something for too long while your phone is next to you, you will come to find that when you start scrolling through the internet, you start getting ads directly related to the conversation that was happening even when you wasn't using your phone. So while you're watching this particular podcast, I bet every time it cuts away to a commercial, somebody's trying to give you something about FICO scores, tax returns, seminars about investing into something, real estate, cryptocurrencies, because Google AdSense has been triggered by your ability to be on the internet looking at something related to money, and they're going to push everything related to money on you while you're on the internet. It's what happens. If you look into two or three different things, if you look into the same thing three different times, it's going to start giving you ads about it. Crazy. Michael said, I was thinking about fingerprints. Since fingerprints don't change from birth, do a database of all baby fingerprints should be able to match adult prints? No, fingerprints do not stay the same from birth. You are fingerprinted as a child, and believe it or not, you're fingerprinted again when you're arrested. And that is how they keep track of your fingerprints. Your fingerprints change over time. And that's why, um, because if you get an injury like you burn your fingers from a cooking accident or touching something hot grease or something like that, or if you cut your fingers, the scars and injuries that you have from existing in life alters your fingerprints even after the wounds heal. And then the fingerprints don't match what was originally in your database from 10, 20, 30, 40 years ago. But whenever you get arrested, you get fingerprinted. Whenever you buy a firearm, you get fingerprinted. And they say that these fingerprints belong to this social security number, this name, driver's license, social security number. Because of that, that goes into the database, which links that fingerprint to the social security number of the first set of fingerprints. And then if you do something wrong and they fingerprint you or they find fingerprints, they will cover fingerprints from the first time around and put it with the second time around. He says, actually, no, they don't. Prove me wrong now. The kids, your dad, your fingerprints from when you were born change over time. Oh yeah. Oh, you had to catch up to that other part. Oh, so if you have absolutely no injuries in life, if you have absolutely no nothing in life, and from the time you are born until the time you mess up and get caught by the police, then those fingerprints might be closer to the originals. But most of us burning our fingertips, most of us cutting our fingertips, touching things, cooking, using a knife to mince things up, we tend to damage our fingertips. And when our fingertips heal differently, which means that more often than not, the average adult does not have the exact same fingerprint pattern as they had when they was a kid. And more to the magnitude with the bioprint, because you're talking about the fingerprint thing. Because we have bioprints to unlock doors, we have bioprints to unlock our cell phones. Damaging your fingers can prevent from unlocking your phone because your fingerprint is no longer going to be the same. The only way that you can minimize that is take multiple different directions of multiple different fingerprints or use multiple different fingers so that if you injure one, then you can use a different one to unlock your phone because you will come to find out that a wet fingerprint doesn't work and a dirty fingerprint doesn't work and an injured fingerprint doesn't work. Yeah, China is fingerprinting everyone plus blood samples, hair samples as well. So they're gonna make sure that they know who you are. They're gonna make sure that they know who you are. So, but again, their crime rate is low. their crime rate is low. They're more likely to have you in a civil courtroom for pissing somebody off than they would have you in a criminal courtroom for doing something you ain't had no business doing. I think they got like a death toll of 10 annually. And part of that death toll, I'm hypothesizing because I don't know exactly what their death toll is. I have to go back and do the research on it to get the specific number, but it is excessively low. What the death tolls that we can have in an hour in America is probably closer to the death tolls that they have from crime in their country in a year or 10 years or something. So we're not talking about like, oh, how many people kill themselves every year or something like that. We're talking about like how many times does somebody die from crime. And I think that if I remember correctly, violent crime over there is something close to like 10 or 20 a year, something like that. But I'm not exactly sure. But that was the last. But that was like 6 months ago, 6 or 7 months ago when I seen that, and I was like, damn, they only have like 10 or 20 violent crimes. Shit, that's safe. We had like three during the time that I said the words violent crime. We had like 60 or 70 over the last couple of minutes of us talking about China fingerprinting blood prints, fingerprinting blood samples. We got high quantities of death tolls and violent crimes in America. It's crazy. But yeah, it is pretty strange. It is pretty strange. You need a kidney, go to China. They got like 4 billion plus people over there in China. So I mean, if you need anything, the cure for AIDS, go to China. If you need, and Magic Johnson still alive. Magic Johnson with AIDS outlived Michael Jackson with his Villalago. How? You supposed to last 5 years with that or less. Magic Johnson did live 20 plus years. He lived a full life. He outlived people who didn't have it because he went to China. Y'all got to understand. Make sure y'all like and subscribe as y'all come through here. Now, for the storm clouds on the horizon, the biggest risk that Alphabet is experiencing is existential circumstances because its core search advertising business model could be eroding. Generative AI is changing how people look for information. So instead of clicking on a list of blue links where the ads are, users might get their answers directly from an AI. And this threatens the cash cow business that funds the entire company. So while Google is building its own AI features, it's still not clear how it will make money from this new world while people accept ads in an AI conversation because they don't want to have to pay for it and they will pay a premium so that they don't get the ads, will it be as profitable? Competitors like Perplexity, which I've shown you yesterday is very effective, and OpenAI's Chat GTP are chipping away at Google's lead. This is a slow moving threat that investors need to watch very carefully. Any big shift in user habits could have a devastating impact on Alphabet's profits. So, Alphabet's second major risk is the all out assault from regulators across the globe. And this goes way beyond just fines. The US Department of Justice has an ongoing antitrust lawsuit, like I told you guys before, that strikes at the very heart of Google's search dominance. A ruling which is expected soon could force huge changes. One of the ideas being discussed is forcing Google to sell its Chrome browser, which could cut off the financial deals it used to pay Apple billions to be default search engines on iPhones. So they're allegedly proposing forcing the sale of Google Chrome so that you're not going to see that as the default user on iPhones anymore. Losing that default status would be catastrophic, and that is going to make a massive blow towards Alphabet and Alphabet's investors. It doesn't stop with the search. The company is facing scrutiny over its digital advertising business and its control over the Google Play Store on the Android devices. These lawsuits are not just distractions, they are real threats to Alphabet's most profitable businesses. The regulatory risk for Alphabet is arguably higher than for any other one of the Magnificent Seven. And the bad outcome in the DOJ search trial could permanently change the company's future. Now, the fourth company on your list is the undisputed king of e commerce and cloud computing, a company that has completely changed how we shop and how businesses run. Amazon. So make sure that you guys come through here. We've talked about Nvidia, we've talked about Alphabet, we've talked about Amazon, and I believe we've talked about Microsoft. Yes, that's the four that we've covered so far. To many, Amazon is a company that brings boxes to your door, but for investors, the real story is in its other, much more profitable businesses. After a period of heavy spending and squeezed profits, Amazon entered in 2025 with a new focus on efficiency, and it's starting to show. Despite a recent stock pullback on a weaker than expected outlook, majority of that related to the unions that started being formed, the core parts of the business are still incredibly strong. Analysts remain almost unanimously bullish, with the vast majority rating the stock a buy necessity. They see the company with multiple powerful growth drivers ready to fire on all cylinders. Amazon's crown jewel and main growth driver is still Amazon Web Service, or AWS. It's the biggest cloud computing platform in the world, and it continues to be a profit machine. In recent quarters, AWS was responsible for a staggering 60% of Amazon's operating income, despite making up a much smaller piece of total sales. This shows just how vital this segment is to the company's bottom line. So in 2025, AWS is set for another wave of growth, driven by the explosion in demand for AI. As companies rush to build AI applications, they need huge amounts of computing power, and AWS is a top choice. AWS revenue recently grew about 17% to nearly 31 billion, and the division is on track to break 100 billion in total sales this year. So while competition from Microsoft Azure is tough, AWS isn't sitting still. They are developing their own custom AI chip like Triton and Graviton, which could give them a cost advantage and make them less reliant on Nvidia. This focus on providing the backbone for the AI revolution makes AWS a powerful growth engine for years to come. So, Amazon having a second and often overlooked growth driver is its fast growing advertising business. Think about it. When people go to Amazon, they're there to buy something. This makes it one of the most valuable places in the world to advertise. Amazon quietly built an advertising giant that is now bigger than YouTube's ad business. In a recent quarter, advertising revenue beat expectations. So this is an incredibly high margin business compared to the paper thin margins of retail. Every dollar of ad revenue has a much bigger impact on profits as Amazon rolls out new ad formats, including ads on its Prime videos, streaming services, and other segments. This has a long road of growth ahead. So, this combined with a new focus on making its delivery network more efficient is helping to boost the company's overall profitability in a big way. Y'all remember that uh, Jeff Bezos bought out Digitech to put AI in the Amazon warehouses to reduce the cost of manual labor by increasing the quantity of AI labor that is actually 1 day of labor for the same price as 1 hour of human work, where the AI produces 1 day of labor, 24 hours of labor, in comparison to 1 hour of human work. Trying to told y'all, manual labor, y'all gonna be hard up in coming years. Do you think the federal government is trying to overturn gay marriage since the Supreme Court or in the Supreme Court to take attention away from the Epstein files and what they may or may not contain? No, I do not believe that the Epstein files in any way, shape, or form are relevant to the existence of human life in the United States in 2025. I believe that that is just something that people really waste their time with because files from 40, 50 years ago have nothing to do with how the country is currently being run or being modified. I do not believe, if in the event that the Supreme Court does put any effort towards modifications of gay marriage, it would have absolutely nothing to do with the Epstein files. And I believe that um, Donald Trump's paying attention to more important economic changes. Um, State by state, marriage laws are enforced on a state level, not on a federal level. You have to understand that the country's authority starts with loosely written executive orders written by the president that turns into loosely written that more defined laws by Congress, which turns into more defined laws by the federal law. After the federal law, the state law takes those same laws and redefine those laws in more stricter wording, where the cities inside of the state have more stricter wording for the same law, where in counties uh, have even more stricter laws. So the same law that might be broadly spoken as yes, you can, on a state level, you can under certain conditions, and on a city level, you can under even more stricter conditions. So if those conditions aren't met in the city, in the state, of the country, all conditions aren't met uniformly, then where those conditions no longer apply, you're in violation of the law, which means that you have to know what the laws are in your entire state and every city you plan to go to make sure that you're in compliance 100% of the time. Now, we're more free than other countries, so we are allowed to break the laws as long as nobody's willing to put in the effort to report it, or the police officers aren't willing to put in the due diligence to write the paperwork. So we can end up in situations where we're breaking the law, but nobody's doing anything about it. For example, it's against the law to fall asleep in a salon while in a hair dryer. People take naps when they get comfortable. It just happens. But technically, that's against the law. So you have to really understand that that's a complete difference. Now, as it pertains to marriage, marriage is a state by state decision. And while during the Biden administration, more states were more towards it, during the Trump administration, if the new parties in play decide to overturn those decisions, that is not going to change the financial status of already recognized married couples just because of their gender, because you also have to recognize that in this country marriage is a financial contract between two parties, which gives them tax advantages and deductions as a merger of two single businesses, because we are walking businesses. We are walking stock options. That's what our social security number is for. We're walking stock options. And as a merger, that marriage is a binding contract. So once it happens, it happens. Now, if they change something where you're not able to do that going forward, You save $75 in the court. You guys live together. It doesn't matter. And you actually get more benefits when you're single than what you do when you're married because all you have to do is have one of you claim a post office box and the other one claim the house. And then whatever tax deductions that you get twice as many. Because if you get $100,000 worth of deductions as a single person, you get $150,000 as a joint couple. So it benefits you more to file separately and have two single $100,000 claims where you guys can get $200,000 together instead of claiming joint and only getting $150,000. So really, marriage doesn't benefit you financially. It does when you have one of you not working and that person is a dependent that gives you a large quantity of deductions. It also aids you with being a head of household if you're not married, where you and the wife and kids or the husband and the kids or the boyfriend and the kids, since y'all aren't married, are living together and you're the head of household, you can get more deductions that way. But whether or not their marriage happens, it has nothing to do with the Epstein file. I just think people like to try to talk about the Epstein files to really disrupt a normal discussion about how to make, save, and invest money because the Epstein files don't put money in your pocket. They don't take money out of your pocket, and neither does whether or not gay marriage occurs. If they pay for it at the courthouse, it takes like $50 to $75 out of their pocket. But if they don't, I mean, it's not going to stop them from who they are and what they do because marriage doesn't change you. I've said this plenty of times on a podcast before. When you get married, it's not like hitting a Pikachu with a moonstone and transforming him into a Raichu. Whoever that person was before you married him is who that person is after you marry them. And the ring on the finger is just a symbol which you can buy at the store and use anyway without having to pay for all that extra money for the marriage. And going down to the justice of the peace or to the local courthouse and having that paperwork signed, filled out, and pay the fee to process it is really the only thing that changed over your legal tax status, which has absolutely nothing to do with the fundamental traditions of marriage under any religious belief under the God that they pray to. So you technically don't need to get married, uh, whether you're straight or gay, because technically, you like I said, you get more tax benefits as being the head of household. And you could be the head of household as two different residences and still live in the same house because it is what you report, not where you actually are. And then at the same time, you also have to recognize that if you're doing trust, like I told you guys, y'all build up a trust, a family trust, put all the assets in a family trust. Y'all are benefits of the trust, and you're going to benefit anyway without having to worry about the marriage. Get a joint bank account. It's the exact same thing as being married because it's a combination of finance. Most states have a thing called common law marriage, where if you live in the same place with the same person for a number of years, some states are 5 years, some states are 10 years, you are considered to have common law marriage where you guys are supposed to separate your assets. So, funny thing, common law marriage is not exclusive to gender. So, while you might not in some states be able to walk down to the courthouse and pay them to have a man marriage certificate or a female marriage certificate, by law, if you and your homeboy lived in the same apartment for 10 years together, common law marriage indicates that y'all two could technically be married. And if y'all were to separate and one of y'all moved out, there would be a division of property the same way as a divorce, where if you guys didn't mutually agree as to who takes what, because you both contributed to this environment for that period of time, you both will contribute to selling off everything and dividing the cost. It is what it is. He says, from my understanding, the Epstein files are from the past 10 to 20 years, not 40 or 50 years. It doesn't matter how far back it goes. It doesn't matter how fast. It doesn't matter how fast it goes. It could go back 100 years. What matters is that the list is not relevant to day to day operations in America. Donald Trump said it himself. The list is not relevant. So if you want the list, Google it, see if you can find it, download the PDF, read it. But if all the list is going to do is snitch on a number of people that was involved in an activity years ago, does that matter? Because I personally believe it's about as important as a Watergate conspiracy, as Donald Trump paying $135,000, $135,000 for a prostitute and still being a president. Uh, it's about as important as you know 34 counts of felony level treason and stuff to that effect. And all being swept under the rug. It's about as important as, the 30 plus 1 years that Diddy got, that got dropped down to 20 years. It's as important as the 10 years that Mystical got the second time that he got the same charge. It's about as important as when R. Kelly peed on that girl because she didn't get out of the way. It's as important as, getting Jello pudding from Bill Cosby in a limo and not waking up remembering what happened to you. It happened. It's done. It's over with, and it's not really all that relevant. It's not. But you formulated a straw man topic to troll the podcast. I appreciate that. You come appropriate most days out of the week, but the Epstein list is left field unnecessary. But somebody's gonna throw it in there. Somebody's gonna throw it. Somebody wants to, and as soon as they put it in there and I respond to it, they get a nice little laugh off of it. But I don't really think they're talking about the Epstein list is funny because, again, like I said, on this podcast, we talk about how you guys can benefit yourselves financially. So when we talk about things, we will talk about stuff that happens in politics. We will talk about stuff that happens in the government. We will talk about stuff that happens around the world. But the first question that I ask you is, how does it impact you today? Is knowing who is on this list of people who may or may not have fucked up in the past going to change your life today? Is it going to put money in your pocket? Is it going to take money out of your pocket? If the answer to those questions are no, no, it's not going to take money out of your pocket, it's not going to put money in your pocket, and it's not going to change the way you live your life today, why are you wasting your life talking about it? Why are you wasting away burning brain cells to dwell on something that will not benefit you and your life? This is how people fail, by paying attention to stuff that does not matter. You need to pay attention to what does matter. Even when we talked about the tsunami that did not destroy Hawaii, it did in fact show that the global system utilized to track tsunamis and track earthquakes is highly effective and kept a bunch of people from getting hurt, where having no death tolls off of this particular tsunami in Japan and Hawaii shows significant improvements to first response notifications and emergency evacuation warnings, which means that our tax dollars in whatever country that we're in that pays for those systems to go into place, our money's going to good use. So even when I talked about that tsunami, my money went towards the building of that facility, the building of that technology, the salaries of those employees that are watching the storm hit the West Coast. And I need to know that my money is working for me. So when I bring up a topic, I'm gonna bring up a topic that is indirectly or directly impacted by finance. The Epstein list is not one of those topics. So even when we talk about what Trump is about to do with the FICO scores, your ability to renew your car insurance within the next 7 months is going to be impacted by what Donald Trump is about to do with the FICO scores, which we're going to be talking about on Monday. Direct impact. That's the kind of topics I bring to y'all. I don't bring to y'all bullshit. I don't sit here for 2, 3 hours just wasting y'all's time talking about stuff that don't matter. I'm sitting here talking about stuff that even at 70 years old, Michael still owns a car. Michael still pays car insurance. And if what I'm about to tell him about FICO scores will help him improve his ability to get lower interest rates on his car insurance, he can spend less money every month on his car. That in and of itself is worth listening to. We talked about the oil from Russia, gas prices. We talked about the import exports from India, parts for your car, mechanic prices when you start getting car repairs, whether it's a new car or an old car. So think about it. When you ask you here on this and that, we talk about this, that, and everything in between. So there are no wrong questions as long as they are appropriately formatted. But think about the question before you ask it. Will it make you money? Will it take money out of your pocket, or will it compromise your ability to function your day-to-day operations? If the answer is no to that question, while you're free to ask that question anyway, I just want you to understand that you are wasting your time asking that question. It is not a stupid question. It's just wasting your time. It ain't wasting my time. I got plenty of time to finish this show. I just wanted to let you know that real quick. Now, for the risks about Amazon. The first major headwind for Amazon is constant pressure on its core e-commerce business. So while the pandemic pulled forward years of online shopping growth, that trend is now slowing to a more normal pace because the people are taking their ass over to Temu and buying almost the same stuff off of Temu that they can get from Walmart.com and Amazon. At the same time, Amazon is always fighting rising costs, labor, fuel, and the massive expenses of running its logistics network, all squeezing profits. The company is also very sensitive to the broader economy. If a recession hits again and people pull back on spending, Amazon's retail business would be hit directly. Plus, the threat of new tariffs again could force retailers to raise prices again, which might discourage shoppers. Now, this sensitivity to the health of the consumer is a key risk for the company's biggest but least profitable segment. Amazon's other huge risk is the legal war it's fighting with the Federal Trade Commissions. The FTC has filed a massive antitrust lawsuit against the company, and it's not a fight that is going to end anytime soon. The lawsuit alleges that Amazon uses its monopoly power to hurt consumers and the third party sellers on its platform, drop shippers. The FTC is looking at everything from Amazon's Prime service to how it allegedly favors its own products over those of other sellers. They're also targeting the fulfillment by Amazon service, which many sellers feel forced to use to get a good spot on the site. And it is true because I've done drop shipping. If you are doing fulfilled by Amazon, it is next day delivery, which is encouraged from Amazon Prime. If you do not have next day delivery option, and next day delivery means from you or your distributor directly to the customer tomorrow, which is only possible through Amazon fulfillment, you're not going to be one of your product is not going to be one of those promoted by Amazon Prime because Amazon Prime does if you're paying for the membership does zero cost for shipping, next day delivery, which usually gives you 24 hours, one to two business days for you to receive the product from the day that you purchase it, depending on what time of day or time of night that you buy it. Now, the fulfillment situation requires you to pay a higher price to get the product. Worse off is that you have to itemize the product based on the SKU number that Amazon gives you for the product in order for them to categorize it for you at the warehouse. So this means you have to pay for the product to be shipped to you first, attach the SKU number to all of your products, and then ship it again to Amazon so that you can then pay Amazon to ship it to somebody else, which makes you pay three shipping costs instead of you being able to ship the product to Amazon directly from the manufacturer, where Amazon would then ship it to the customer, which is still paying for shipping twice. As a drop shipper, it would be easier for you to get it from the manufacturer, fulfill the order, and then have it go directly from the manufacturer to the customer. That is the issue that they're having right now. Now, the worst case scenario is that a court could force Amazon to make huge changes to its business, or even consider breaking up the company and separating AWS from the retail business. And this lawsuit will be a major distraction and a source of legal and financial uncertainty for long term, which is going to make investors uncomfortable. Investing in Amazon for 2025 is a bet that the strength of its high growth and high profit of the business with AWS and advertising will continue to be more important than the challenges in its massive but slow growing retail segment. But if it can get through the series of regulatory threats and keep its lead in keep the lead in the cloud, the stock still looks like a compelling value for long term investors. Now, our fifth stock, and we've got 5 out of 7, so we've only got a couple more to talk about. Our fifth stock is the ultimate comeback story of the Magnificent Seven, Meta Platforms. Okay. Just a couple of years ago, the company was left for dead. And I know that y'all know Meta Platforms related to Facebook. The stock has crashed. Investors were terrified by its massive spending on metaverse, and Apple's privacy changes had destroyed its legendary advertising business. But in an incredible turnaround, Mark Zuckerberg declared a year of efficiency, and Meta has been roaring back. Now, I know Elon Musk was talking about how Mark Zuckerberg uh, did something that was able to undermine a platform and bypass its algorithm and then utilize that to sweep over and start turning back profits. But hey, whatever you got to do to make money. Because some of us, if we could get gas for free, we wouldn't pay for it. Even if we knew that not paying for it is a crime. If we could get gas for free, we wouldn't pay for it. The stock has been a top performer, and recent quarterly results were a masterclass in execution. Revenue in Q2 of 2025 shot up 22% year over year to 47.5 billion, while earnings per share jumped an incredible 38%. That comeback is being driven by a powerful mix of AI powered fixes to its core business and a smart open source approach to innovation that is winning over developers. So, Meta's main growth drivers is the amazing revitalization of its advertising engine, thanks almost entirely to AI. So, when Apple's privacy changes legitimate or limited ad tracking, it was a direct hit to Meta's business. For a while, it was a huge problem, but Meta fought back by building one of the most advanced AI engines in the world. Tools like Advantage Plus use AI to help advertisers find customers without the old tracking method, and it's working incredibly well. Ad impressions are up, and importantly, the average price per ad is also rising, which shows strong demand. Meta is also giving advertisers new generative AI tools to help them create ad campaigns more easily. This AI focus is turbocharging the core business, which still includes the most dominant social platforms on earth, which are Facebook, Instagram, and WhatsApp. By using AI to make its ads more effective, Meta is cementing its place as a must have partner for business. Meta's second growth driver is more strategic. Its decision to open source its powerful AI model, known as Llama, while rivals like Google and OpenAI keep their best models secret, Meta has made it cutting edge AI available for free to researchers and developers. And this has been a huge strategic victory. It has created a ton of goodwill in the AI community and led to a wave of new innovation built on Meta's tech. But that isn't just about goodwill. It's about building an ecosystem. As more developers and companies build a llama, it creates a network effective to help Meta. The long term plan is to make money through partnerships and business services. For example, Meta is partnering with cloud providers like Microsoft Azure and AWS from Amazon to make it easier for businesses to use its models. Beyond Lambda, Meta is quietly working on monetizing its huge message apps, such as WhatsApp and Messenger, which most of us switch to Messenger from our standard cell phone app. And then a lot of us who don't want our cell phones to get out there switch over to WhatsApp and use our WhatsApp phone number to communicate with people on the other side. And for business communication and payments, this represents another massive untapped opportunity. Park is back. Special shout out to Park. Only India purchasing crude oil from Russia is supporting war, but not China purchasing oil from Russia supporting Russia. Neither US providing weapons in Ukraine supporting the war. Okay, so we're back on yesterday's topic. Um, special shout out to Park. Yes, that is accurate. One of the problems that is happening is that the difference between buying bare necessities and flipping for a profit is going to be one of the biggest concerns. So, as we discussed on yesterday's show, India doesn't just buy the crude oil, India buys the crude oil in massive surplus, sells the difference, and then takes the extra money and goes back and buys even more crude oil, far beyond the crude oil that they actually need. Buying more than what you need is providing more funding to Russia than what you need to provide because you don't need all of the stuff that you bought. Yeah, if you're able to fast track and sell all of this oil to other countries that would otherwise not be buying from Russia in a limited capacity, then that would definitely be funding the war. Likewise, those parties, special shout out to Slughorn. Yes, what's up to you too? Likewise, providing resources to Ukraine is not preventing Ukraine from reaching peace. It is preventing the minerals from Ukraine from being destroyed. Likewise, we're also going to throw in the fact that the U.S. provides old weapons and old weapons blueprints on the black market to a lot of places, not just Russia. And the difference is that, like I said before yesterday, what part of USA are you from? Like Florida? Yes, Florida. Like Russia, the sanctions, the high levels of sanctions, and the freezes on funds from the U.S. to Russia lead to the discussion that we had yesterday that while Russia does have capital owed to them, their accounts are not being dispersed as readily because they're still under they're still attacking Ukraine. So once they stop attacking Ukraine, those frozen funds would be released. So again, um, you're you're missing the point there is that the goal is to stop the war so that the US can get the minerals. And in order to stop the war, you got to stop Russia's attacks. And in order to stop Russia's attacks, the unnecessary money that's being given to Russia from India, far beyond India's requirement for basic fuel, is the problem. So, in order for the US to put a stop to that, because India can get oil from somebody else, like Canada or the US, because we've got 100 years plus worth of oil, um, they choose to get it at a significantly cheaper rate from Russia. So, until Russia stops attacking Ukraine, India is not going to profit from the US. But there are also some underlining things that are going to be some trade practice forces from the United States, as we discussed yesterday as well. So yeah, but I'm glad that you took the time to go back and do the extra research before you came back and re-ask the question. Make sure that you guys like and subscribe. If you got any more information, I'd love to hear it. Definitely love to hear it. Now, the biggest risk for Meta, the one that scares many of the investors away, is the metaverse. Meta's Reality Labs division, which is in charge of its virtual and augmented reality dreams, is a financial black hole, meaning they're taking in a lot of resources, but they're not turning out a lot of profits. The division recently posted a staggering 40, $4.53 billion loss in a single quarter, where the company's total capital spending for 2025 is projected to be between 66 and 72 billion, a massive increase with a huge chunk going to an AI and the metaverse. Ah, he spent time in South Florida. How did you like it? Because I feel like it's hot over here. While Mark Zuckerberg sees the metaverse as the next big computing platform, the path to making money from it is completely unclear. They have no idea where they're going to get profits from this. So far, it's been a colossal drain of money and resources with very little to show for it in terms of revenue. These losses are being paid for by the incredibly profitable ad business, but investors are right to be skeptical. This is a high stakes, high reward bet, and if the metaverse fails to catch on, it will go down as one of the most expensive corporate gambles in history. I said, did you buy YouTube subscribers because you have 40,000 subscribers? Actually, no, I did not buy YouTube subscribers, and I have far more. There's actually a few thousand people watching right now, but they've been working on their counters since they changed everything over to the vertical feed, and everybody who's using the vertical feed of the 9 by 16 instead of the 16 by 9, we have counters of people popping in and popping out from the shorts reel on top of the people that are consistently watching the platform. Then they also changed over the difference between individuals that stay and interact versus people who just pop in, look at it, and then walk away. So the counters are not 100% accurate on the channel, on anyone's channel. So if you were a content creator, you would have gotten that update, that information, and they've been working on it for the past 6 months. But in the meantime, they're also going to be making changes as to the accessibility of minors to adult content. So there's going to be even more changes and fluctuations with your AdSense revenue, and you're going to see more changes with viewership and how the counters or not, yeah, how the counters count your views. So again, yeah, I don't need to buy subscribers. People like and subscribe. I typically get anywhere between 500 and 1,000 additional subscribers every day. Um, so yeah, I love the way you try to make it seem like I operate off of a bot, though. Uh, I don't really care because I'm here to provide you guys with valid information. So, if in the event you want to learn something, hang around. But if not, by all means, you can go ahead and tiptoe out. Now, Meta's second key risk is its continued overwhelming dependence on a single source of income, which is advertising. Despite trying to diversify, ads still bring in almost all of its money. So this makes the company very vulnerable to the economy. In a downturn, ad budgets are often the first things businesses cut, which would directly hit Meta's revenue. He said, I like your channel. I subscribe. Well, I appreciate it. I was just curious. No worries. You can be curious. Typically, I have people who troll the channel, and the first thing they try to do is make it seem like because I have a large quantity of subscribers, that the lack of interaction on the podcast uh, leads to me not having real people on the podcast. But if you go back and look through the podcast, I am an interactive podcast on Twitch, Twitter, and YouTube. And anybody who chooses to interact, I interact with them. However, the fact is that because I'm providing you with information, a lot more people spend more time uh, actually listening to the channel and not actually interacting. And then some people are taking notes because we're talking about financial information, we're talking about self improvement. So while it's an open forum podcast for open discussion, it's less likely that people are going to chime in because it's almost like a seminar as opposed to an open forum discussion. So while people can dive in whenever they want to with a question, in the podcast, not too many people are used to doing that. So we have a larger quantity of people that are watching, listening, and learning, and a less quantity of people that are heckling and commenting on the channel. As long as the comments are appropriate, I try to entertain them. That I'm not trolling you. I enjoy your streams. Hey, I appreciate you coming. Thank you very much. But doing the digging, this particular channel runs. We're actually right now upward of 100,000 views a month, which isn't saying much, but most channels are a million to 2 billion subscribers operating at less than 0.1% of their subscribership is their monthly viewership, because not everybody that subscribes to the channel comes back and watches the show every day. Hopefully I'm providing the type of meaningful content that everybody that subscribes to my channel, or at least 75% of the people that come and subscribe to my channel, watches my channel at least 3 times a week. Um, Once for Sunday, once for one of the business things, Monday through Wednesday, and once through one of the personal growth things, Thursday through Saturday. That likely would be the average case. I understand people have to work, people have things to do. Some people go to bed. They have personal life choices, so I don't expect them to be here every night. But I would like if they could make it a habit to do so. But as they rotate out, um, 40,000 subscribers drawing 120,000 views a month is approximately 3 views per month per person, which makes sense. It's not quite the weekly traffic, but we're a small podcast, as I explained before, because YouTube has this really big problem with controversial topics. Like when you guys put up Epstein lists in the comment section, we're talking about politics, we're talking about wars, we're talking about uh, personal growth, toxic relationships, stuff to that effect. All of these topics that I cover on this show goes into YouTube's restricted area. So even though I have a larger quantity of individuals that are subscribed to my channel, it is harder to come by to see my videos if you don't turn off restricted mode on your cell phone, because YouTube is trying their best not to get sued like Facebook and Instagram did, to because the kids have accessibility to content that they're not supposed to be looking at. So yeah, um, you can't really pay attention to, if you're paying attention to the number of people that's watching the show, you're not paying attention to the show. It is what it is. Now, as it pertains to Meta, at the same time, the company faces a tough regulatory environment, especially in Europe. So new rules like the Digital Marketing Act could force Meta to offer users a version of its app with less personalized ads, and moves that some analysts worry could severely cut ad effectiveness and the region. The constant scrutiny over data privacy and its market power means that the threat of new regulations and massive fines is a permanent part of investing in Meta. So investing in Meta is a 2025 tale of two companies. You're buying an incredibly efficient and profitable AI powered ad machine that is firing on all cylinders, but you're also funding a huge, extremely expensive, speculative bet on the metaverse. If you believe in the core business and can handle the massive spending on Reality Labs, the stock's current valuation could still be a good deal given its growth. However, the metaverse is the ultimate wild card that could either send the company soaring or drag it down. Now, the sixth stock on our list is the most valuable and arguably the most iconic company in the world, which is Apple or Macintosh. Don't you guys understand now? Now, for a decade, Apple has been a money printing machine driven by the incredible success of the iPhone and a powerful high margin ecosystem of hardware, software, and services, where iPhone and Macintosh have all apps and ads exclusive to the device provided by the Apple Store, and your warranty only is covering your device if you only use Apple exclusive supported products. If you use anything else outside of the ecosystem, your device is not covered. It was the first US company to hit a $1 trillion market cap, and it has since blown past the 2 and 3 trillion dollar marks. But heading into 2025, the story around Apple is changing. The law of large numbers is catching up, and the explosive growth of the past seems to be slowing down. Shorter than expected sales for the new iPhone and tougher competition in key markets like China have raised questions about its future. Yet, Apple is a master of reinvention, and it has two powerful growth drivers that could get things going again. Apple's most important growth driver for the future isn't hardware, it's the services division. This is Apple's secret weapon for generating steady, reoccurring, high margin revenue. The service segment includes everything from App Store commission to subscriptions for iCloud, Apple TV, and Apple TV Plus. It also includes the massive payments Apple gets from Google to be the default search engine. Again, why Google got sued. This segment is growing fast and is much more profitable than selling phones. Apple now has over 1 billion paid subscriptions across its services, creating a massive and loyal revenue stream. This is a magic of Apple ecosystem. Once you buy an iPhone, you get pulled into this world of services. As this segment becomes a bigger price of Apple's total revenue, it will make the company's overall earnings more stable and profitable, which is something Wall Street loves. Apple was late to the generative AI party, but it's now arriving with a classic Apple approach. Their new suite of AI features called Apple Intelligence isn't about having the most powerful, all knowing chatbot. Instead, it's about deeply and smoothly integrating useful AI into the operating system of the iPhone, iPad, and Macintosh. The strategy is focused on privacy and personal context, especially since their FaceTime got hacked, letting the AI help you manage notifications, summarize text, and create images, all while keeping most of the data processing on the device itself. This is a classic Apple move. And here's the catch. To use these advanced AI features, you'll need a device with a new enough chip to handle it, which forces you to upgrade your phone. This is expected to be a huge driver for sales, potentially kicking off a new iPhone super cycle as millions of people upgrade their older devices just to get Apple's intelligence. This could be a catalyst that reignites iPhone growth. The biggest risk to Apple's growth is one that's building for years. The smartphone market is mature. Pretty much everyone in developed countries who wants a smartphone already has one. This means growth has to come from convincing people to upgrade more often or by winning in emerging markets, which is getting harder. So you got to understand the prices. You got two things going on here. The prices between Apple and Samsung are those two are competing head to head on phones. There are a bunch of other Androids, but the top Android is Samsung Galaxy directly compared to iPhone product. Prices are the same roughly. The largest Samsung S25 Ultra and the iPhone 16 Pro Max are about exactly the same, short $100 difference, where Samsung's cheaper than iPhone. Irony is that iPhone is using older model hardware from Samsung, so they almost look exactly the same. Some features differ, like the color, the screen design, stuff to that effect. The user interface is more user friendly for iPhone, so you don't have to be a third grader to know how to use an iPhone, but it is more customizable and closer to Linux to use an Android. So it is the difference between somebody who wants to micromanage the developer portion of their cell phone versus somebody who just wants to plug and play and use the cell phone, which is going to be the deciding factor between Apple versus Android. Apple, as a result, does not have the capabilities to do the type of promotion to convince a solid Android user to switch over to iPhone. And likewise, Android does not have a solid argument to convince people to switch from iPhone over to Android outside of the fact that it's less likely to get hacked since there's too many different platforms out there and hackers work for the largest majority of results with the smallest quantity of effort, and there's a larger majority of individuals with the only iPhone type on the market versus a plethora of Androids that have different program systems that do not compute with one another, that would not all come down to the same virus. And beyond hacking, the user friendliness and high modifications of an Android is, along with its price difference, probably the only thing convincing the average person to switch from iPhone over to Android. But the other problem that you have when it comes down to switching from iPhone to Android is that people believe that there's a status symbol for iPhone the way people used to believe that drinking milk was healthy for you. So the whole milk does a body good slogan had a bunch of people buying milk just because of the slogan, not because it was healthy for you. Because the lactose and lactase in milk is not good for the human body, which is why so many people end up becoming lactose intolerant and start leaning towards almond milk. Likewise, the prestige of iPhone. I've even heard females say, "Hey, the guy that's an Android, I have a collection of Androids. So if she doesn't like it, she's not valuable." That's but people devalue another person because they don't own an iPhone when iPhones are designed for the computer illiterate. Isn't that odd? I just had to throw that out there real quick. It is literally user friendly, meaning that you do not need to know what you're doing to do it. Whereas with an Android, you really got to know what you're doing to do it. There are things that you will miss out on an Android until you figure out how to get it done. But with Macintosh, no. With an iPhone, no. You can ask Siri to do it for you because you don't know how to do it, and it'll get done. which, in my opinion, technology, that is a way that technology allows the ignorant to stay ignorant, because instead of us putting forth effort to learn how to do more, we're relying heavily, dependently on an AI platform to do it for us so that we don't ever have to learn. Now, the problem comes in technology is your friend until it's not. And the problem with that is that the moment that the technology is not functioning for you, the moment that you're not in a good network area, the moment that Tesla turns into the next Skynet and takes over the world, you're not going to be able to depend on that AI. And in that moment, you're not going to have the common sense or natural skill set to function without that AI. It is what it is. And that's across all platforms. But I mean, those people that are extremely codependent to the AI of Apple, you will come to find that yeah, it's not as awesome as it thinks. Especially like when Michael was talking about earlier when we were talking about how Big Brother's been watching us. There's more cameras pointed at us than at space, and you think about how the cell phone is wiretapping your house, Alexa is wiretapping your house, so every conversation that you have in your house is being monitored by an entity that you are not familiar with. Just something to think about. Now, the problem is especially bad in China because one of Apple's most important markets is experiencing competition from local champions like Huawei, which is getting fierce. Huawei, which is nearly crushed by U.S. sanctions, has come roaring back with new advanced phones that are taking market share directly from Apple. On top of this, there's the geopolitical tension between the US and China. A rise in nationalism could lead Chinese consumers to choose local brands, creating major headwind for iPhone sales. Slowing iPhone sales is a huge risk as the device still brings in over half of Apple's total revenue. So, Apple's second major risk is a direct attack on its most valuable asset, which is tightly controlled ecosystem, often called the walled garden. The U.S. Department of Justice has filed a landmark antitrust lawsuit against Apple, alleging that the company maintains its smartphone monopoly through anti competitive behavior. The lawsuit targets the very things that make Apple's ecosystem so powerful and profitable. It alleges that iPhone illegally blocks cross platform messaging apps, the green bubble versus blue bubble issue limits what third party smartwatches and digital wallets can do, forcing you to get the iPhone or Apple smartwatch, and blocks cloud gaming services from app stores. This lawsuit is a direct threat to Apple's key revenue source, the Apple iPhone and Apple Watch, and the services division. If the government wins, a court could force Apple to make huge changes like allowing alternative app stores or making its devices work seamlessly with non Apple products. This would effectively tear down the walls of the walled garden, threatening the very business model that has made it the most valuable company in the world. Rounding out our list is by far the most controversial and volatile stock market, not just in the Magnificent Seven, but in the entire market, Tesla. So, for those of you that are watching us from Twitter, Twitter X, special shout out to Tesla. After the wild ride up, Tesla has had a brutal 2025. The stock has been hammered by slowing sales, intense competition, and worries about its future. Its market shares in the EV space has been shrinking, both in the US and in key markets like China and Europe, where it's facing off against a flood of new competitors. And yet, to look at Tesla as just a car company is to miss the entire story that its biggest supporters are betting on. The investment case for Tesla in 2025 and beyond is a pivot away from just selling cars and towards a future as a leader in AI, robotics, and autonomous technology. Tesla's biggest potential growth driver has little to do with how many cars it sells next quarter. It's all about cracking the code of full autonomy. The company is pouring a ton of resources into its full service driving software while it's still not truly autonomous. Recent versions have shown major improvements, and Elon Musk insists the company is close to a breakthrough. They did um, advertise that they have full service driving capabilities in Teslas now. The end goal here is the robotaxi network. The idea is that millions of Teslas with full service drive capabilities could operate as a huge autonomous ride hauling service, generating recurring revenue for both Tesla and the car owners. While the timeline is completely uncertain and there is no regulatory approval yet, any real progress towards unsupervised full service driving would be a massive catalyst for the stock, completely changing how it's valued. Because right now, while they do have the driverless or the assisted driving scenario with the full service driving capabilities, the car still has the current requirement that there must be a driver in the driver's seat. And with Tesla going left off a cliff instead of going right around the curve, it is probably better to still have somebody behind the driver's seat. Tesla's second key growth driver is its expansion into businesses beyond cars. The Tesla Energy division is becoming a serious player. Sales of its Megapack, a large scale battery storage solution for utilities, are growing fast as the world shifts to renewable energy like solar and wind. The need for huge battery storage is exploding, and Tesla is one of the few companies next to Solarion and scale to meet the demand. The other long term moonshot bet is the Optimus humanoid robot. While it's still in its early stages, the vision is to create a general purpose robot that can do tasks in factories, warehouses, and eventually our homes. If Tesla can pull this off, the potential market for a useful humanoid robot is almost unimaginably large. These ventures for full service driving, energy, and robotics are why Tesla has bull behavior and believe that valuing it as just a car company is a huge mistake. Now, the very real and immediate danger is that Tesla's biggest risk is the one that's been crushing the stock all year. The EV market is no longer Tesla's personal playground. It is now a brutal, hyper competitive battleground. In China, companies like BYD are not only making great EVs at lower prices, but are also outselling Tesla globally. In Europe and the US, legacy automakers like Ford, GM, and Volkswagen are rolling out dozens of new EV models, chipping away at Tesla's market shares. This flood of competition has led to a vicious price war, which has destroyed Tesla's once amazing profit margin. The company has been forced to cut prices again and again to keep demand up, which has hurt its bottom line. Y'all notice that there was a 3 to 7% share drop when the EV tax or the EV tax credit was removed. Come September, which is a couple of weeks from now, there is going to be an even bigger dip in Tesla shares because the high rise spikes that are happening right now, get it while you can. EV is only taking $7,500 off of the value of a Tesla that is rated at $50,000, where the taxation on that $50,000 is more than the $7,500 that you're saving on the tax credit. Then they throw down the interest. Now, keep in mind that $55,000 Tesla is $10,000 to $25,000 more than the average car because you can go and get you a Nissan Maxima, a Honda Civic, or a Toyota Corolla for closer to $20,000, where the price of one Tesla is the price of two Honda Accords. The price of one Tesla is the price of two Honda Civics. The price of one Tesla is the price of three Nissan Versas. So I don't understand why people are spending so much extra money for an electric car when the carbon emissions to create the electric battery costs us 10 to 20 years of pollution in order to build the electric battery. And the car must survive 25 years before you turn a profit off of the electric battery until such time as you start leasing out your car in the robo-taxi rideshare service that Tesla has yet to release to the general public. While the promise of a new lower cost Model 2 could help it reach more customers, the timeline for that car is still unclear. The days of Tesla having the EV market all to itself are over. Tesla's second major risk is a mix of execution challenges and its still high valuation. The company's biggest projects, mass producing the Cybertruck, achieving full self driving, and developing the Optimus robot are all incredibly difficult engineering and manufacturing problems, specifically because the Cybertruck does not do what he said it was supposed to do in the debut in 2019 and in 2020 when everybody started jumping onto the 2.5 million man pre-registered list. That is still pretty high. We also have to understand that the truck frame bends under excessive weight, where regular vehicles do not. The 30 times rolled steel is not as durable as we thought. We've had trucks with body parts falling off. We've had battery life not lasting as long as we had hoped. The truck does not have the tri motor. They have put out the quad motor, so you're not going to see the tri motor as of yet. And you do not have the 500-mile range on that vehicle. Most people that were grabbing a Cybertruck for its bulletproof capabilities. It is not technically bulletproof; it is bullet resistant, but up to a 9 millimeter, of which you can tear that vehicle up because somebody has already done that, where the bulletproof or bullet resistant windows did not hold up to a one mag dump. So you're not getting what they claimed you were supposed to get, and until they get to that level, you're still on reserve. So the Foundation series that is paying $25,000 more for the Cybertruck than what it was originally advertised at about $79,000. And then they bumped it up to $99,000. And now they're bumping it up to $125,000 in order for you to get the Foundation series. It isn't worth what they advertised it about at $79,000. And now they're charging almost $50,000 more for it. Tesla has a long history of missing its own ambitious deadlines, and any major delays could shake the investor confidence. So, this execution risk is made worse by the stock's valuation. So, even after its sharp drops, Tesla stock trades at a forward price to earnings ratio that is much higher than any other automaker. And this valuation is pricing an enormous success from its future bets, like Robotaxi. If those bets don't pay off on time, the stock has a very long way to fall. Finally, there's an undeniable key person, risk, with Elon Musk. His leadership and vision are central to the Tesla story, but his focus is often divided, and his public statements frequently create volatility. The company's future are tied, and the fortunes is also tied to his, for better or for worse. So there you have it, a breakdown of the seven stocks that will dominate the market conversation in 2025 going into 2026. Have we seen the Magnificent Seven is no longer a single entity? It's a group of individual companies, each with its own powerful growth drivers and its own set of serious hidden risks. It offers a pure play bet on the AI hardware boom, but at a price that demands perfection, is masterfully weaving AI into its software empire, but faces a renewed regulatory fight. Alphabet is fighting to protect its search kingdom from AI while building a cloud powerhouse. Amazon AWS and ad businesses are on fire, but its retail side faces headwinds and a major FTC lawsuit. Meta has pulled off an incredible AI powered turnaround, but is still burning billions on its metaverse stream. Apple is counting on services and a new AI upgrade cycle to reignite growth while fighting an attack on its walled garden. And Tesla is asking investors to look past its current car business struggles and bet on high risk, high reward future in AI. Now that you have a clear picture of not just why these stocks could soar, but also what could stop them, building a portfolio for 2025 isn't about buying all seven. It's about understanding these specific dynamics and deciding which of these stories fits your investment strategies and risk tolerance. And remember, diversification is key. So even if you're bullish on these names, putting your entire portfolio into just a few tech stocks is incredibly risky. Consider balancing them with a broader based ETF to get exposure to the rest of the market. The market in 2025 will be fascinating to watch for the remainder of the year, and the performance of these seven giants will be a huge part of the story. If you guys found this breakdown valuable and want to stay ahead of the curve with more analysts like this, make sure that you take the time to like and subscribe to the channel with turning on those notifications so that even if you watch us from Twitch or Twitter, you get reminded that we are live so that you can get all the information that we've got to give you. Now, I want you to know, and I want to know what you guys think. To drop your picks and your reasons in the comments down below. I read every single one and would love to start a conversation. Now, to Wednesday, we're supposed to be discussing one of the upcoming countries that we're going to be utilizing to learn about investing around the world. So I'm going to be giving you guys more information about that tomorrow. And then I'm going to be filling in the rest of the week's missing gaps. But I want you guys to remember while you're still here that on Monday, I'm going to be telling you what is changing about the FICO score based on executive orders from the president. And I'm going to be giving you an inside walkthrough as to what you can do to improve your credit score by analyzing your credit report and disputing correctly to remove most of the information that is on your credit score that should not be there, that is negatively impacting your ability to be successful. By knowing exactly what, and keep in mind now, there are a lot of people that are trying to sell this information to you, and I'm gonna give it to you for free. So you need to take time out of your day on Monday to make sure that you tiptoe back over here and come and see exactly what we've got to offer, because the information that I'm giving you is going to be federal statutes, federal regulations, and a template on what to tell the three major credit agencies to get them to improve your credit report effectively and legally, so that going forward, when you utilize your credit score and your credit report for loans and mortgages and other such things, that your credit report will reflect you in the most positive light. With that being said, I want to start off by saying, ladies, as long as the situation doesn't make sense, I'm going to keep asking you to make it make sense. So, ladies, please make it make sense. And fellas, we're about 72% male driven podcast from the male perspective. And I give you guys this information to help you guys become higher value men by showing you ways to improve your finance and putting money into your pockets and helping you make better decisions so that you can improve your personal lives. Your personal life it affects your finances, and your finances affects your personal life. So I'm going to work on both of them. Half of the week, Monday, Tuesday, and Wednesday, we're working on your money. Thursday, Friday, and Saturday, we're working on your personal life. And Sunday is questions and comments for the fans, where that's probably the most appropriate location to put the Epstein list question. So with that being said, I want to thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I'm going to see you guys tomorrow night.
Chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command.